evening. It's Quant Trade Edge, and today I was going to share with you one of my best timing indicators for the general market. And we'll use the SPY, the S&P 500 index as a proxy for that. This right here is VXX. It is the exchange traded note for the short-term VIX futures. You could also use the straight up VIX index for this, but it tends to work really well on the VXX, and also the VXX is actually tradable. The VIX index isn't particularly tradable. It's a theoretical number. It's really very simple, and this was popularized by Larry Connors, so I can't take credit for it. That's where I first heard of this strategy. But basically, when the 2-period RSI is greater than 90, you have an extreme in volatility. So let me put an indicator on here that will tell us when we got that signal. And you'll see that we got that signal on February 10th. And what I'm going to do is go ahead and just write these dates down, and we will look at them in a second. So we have February 10th. We have February 22. And we just came off of 2 days, March 10th and March 14th, 2 consecutive days. Let's go back a little further. We have September 16th. We have 2 consecutive days, September 26th and 27th. And then we had 3 consecutive days, October 7, 10, 11. October 7, 10, 11. Now, you can tell, this being a tradable index, if you were to have shorted this close, you made money the next day. And these moves are significant. This is 79 down to 71. That's about a 7.5, about 10% move in one day. Here, if you shorted 82.56, let's say you added 83.84, next day you got an exit 79. Which is about a 5% move. And, if you wanted to look at this mechanically, you would say on every close above RSI 2 greater than 90, you short, cover when RSI 2 closes below 50. Here we got 17. Here we got 34. Now here you would have shorted 84 and a half, call it, 85.32, 86.92. And it wasn't until this day down here, you got to close at 83.40. So again, each of the 3 days, whatever you shorted would have been profitable at this exit here. Here, no heat. Next day, profitable. Again, that's 46 from 48, so call it 5%. Here, 50.60, and it actually took 2 days to get below 50. Down to 47. So again, 3 off of 50, call it 6%. And again here, you had this short, and you did get below 50 on the close on the 14th. And typically when you have this pattern, I've seen that you can actually go a little decently higher because this relieved the pressure, but this will likely set up another, short in VIX. Now, in the volatility index, VXX. Now, I don't want you to, all of these have been winners. If you go back, you'll see even more winners. Like, okay, here, this might be an actual loser. 1, 2, 3, and then you exit here. So maybe on a weighted average basis, you'd be okay. But, these 2 legs were lower, 90, 80, 92, 20 compared to 95, 80. But then you would have had this piece here at 103 down to 95, 80. But I don't want you to get the idea that this is some sort of panacea, because you can also get run over. Here from 81, 85, 92, this intraday spike would have taken you to 111 before you get an actual system exit around here. And around here, again, you've got a couple of losers and then a couple of, 1, 2, 3, 4 or so winners. But it all depends on how you managed your capital. So I don't want you to think that this is, a reason to go short volatility. That's a way to blow up. However, using deep in the money puts, perhaps, buying a put spread, selling a call spread, things that, but when you can create your structure with a limited downside, that is a better way to play it than just outright shorting volatility. But another way you can do this is just use this for timing. When you see this, you know that you're close to a short-term bottom. When you see this, you know you're close to a short-term bottom, and you can use that to then load into certain stocks, the ones that are perhaps acting the best. And the reason I wrote down those few days is let's go back to the SPY and see what those days look like. So the first day we had written down was February 10th. So, I guess if we go in chronological order, 9/16 was the first day. So September 16th is this day right here. So if you would have bought around that close, you got one day up after that. So you did have an opportunity to exit, and the VXX would have given you the exit, but you could trade it in SPY instead of VXX. And let's see here, 9/26 is this day right here. And there were two consecutive signals on the 26th and the 27th, and there's your relief day. 10/7, there were 3 days after 10/7. So 10/7, October 7th was one. October 10th and October 11th. So these 3 days you got signals. Then there was a day of no action. There was a day with a gap lower and rally back up. But you can see this all kind of marked a bottom for this next leg up. And most recently, we, February 10th. There we go. This day is February 10th. And it marked an extreme, and we had a few up days from there. And again, here, if this is 408, the next day was 412, so only about 1% higher. But again, you'd want to pick your high beta names that are acting well to play this kind of a bounce. And let's see, February 22. So this is 222. Looks like it came a couple days short of a bounce. And then the most recent ones were March 10th and March 14th, which did get one nice big day up. And that was not Monday, that was Tuesday of this week. So you can see how this works well for timing, and you want to put that in the context of everything else you're doing. One thing I'm looking at right now, this is on the SPY. This is roughly our trend line. It touches here, barely misses there, but I did that to be able to touch here. This I don't mind cutting because it gapped up and puked, so that was just a rejection wherever it happened. I don't feel is that significant. So you could either do that, or you could even draw it off of this line if you want to keep that trend pure. But both of these will give you roughly the same picture, and that picture is we are currently fighting to hold this back test, right? This whole year has been, from January to January has been kind of our bear market, and we just broke above this, and really this break above could be considered a trap because we went up here and failed. But if it is a true breakout, then we would come back and retest, and that's what we did here, and we bounced, but then we came back again, and this is sort of our bank failure panic, and we're testing around that line, currently closing above it. So I think this range is very significant. Let me draw this box better. This box from around this low to around this high, whichever way we go from this box will set up the next, probably week-long or more trend, and possibly a lot more than just a week. If we successfully defend this back test, we could be off to the races. If we fail at this trend line, we could be back into our bear market, testing down here, testing down to the lows. Remember, the technicals, keep them aside from all of your fundamental opinions of the market. I'm aware the yield curve is extremely inverted. But the one thing you'll notice on yield curve inversion, if you look at the different historical times it's happened, and that is when we're still kind of printing new lows, and we've only recently just come off the bottom. And when you come off that low of the yield curve inversion, there's typically 4 to 6 months before the market actually tops. So that could be clear runway to new highs before the actual recession hits from that yield curve inversion. Or that could already be priced in and our direction could be lower. So, again, you want to be careful not to mix too much of a fundamental view with your technicals. Your technicals tell you where you'll be wrong. Here below this low from Monday, and we're wrong. We need to be short. Above this high from Tuesday, we need to be long. It's that simple. So anyway, we're back testing this breakout trend line with bank failure type panic, and also an extreme in the volatility index in the VXX that we saw. We reached an extreme here. So there is a lot of potential for a bounce from here, but again, just wait for this range to break and you'll know which way to go. So that's it for tonight. Hopefully you learned something. Whenever I step away from the markets for weeks or months, when I come back, I sort of wait until we have one of these VXX, or VIX spikes, because then I know where we are in the cycle. When we have that VIX spike, that's kind of the end of it, and we typically get the next leg up. So we'll see. And, and also another just interesting note of timing, VIX futures expired this morning. And typically from VIX futures expiration to futures expiration is where you have one whole volatility cycle where the dealers are set up in a certain way and they want that to play out, and then you can have kind of a different move. So, really, I think around February 14th was when we had the last VIX expiration. So, expiration to expiration, this move was pretty much down. Next move, could be further down, but there's also a chance for the cycle to change on that. Anyway, keep asking questions. I love to answer them, and I will do something on the umbrella. I know a lot of people have asked about the umbrella and the hoagie, and we will get to those eventually. I just wanted to point this out because it was happening in real time. Have a good evening.